Okay, well, welcome back to the podcast. It's been a couple of years since I've done one of these, and mostly the reason for that is that most of the content that I've decided to put out has been on Substack, where I've been posting for pretty much continuously for the last 2 years. Now, that's been great. I've enjoyed that a lot. Probably getting to the point where another modality would be good additive to what I'm doing. So yeah, I kind of wanted to reintroduce the pod, do a little bit of a reintroduction of the newsletter, and reintroduce why I'm doing what I'm doing here. So firstly, reintroduction of the pod. This is supposed to be an accompaniment to the work that I've been doing and continue to do on Substack. In the past, when I had done this, I posted just a bunch of different types of things, which were a little bit incoherent, kind of feeling my way around, which has also been my experience on Substack. So that's kind of the purpose of the pod. I asked around now little Discord server, what people would be interested in seeing, hearing, and there's a bit of adverse selection in there because people who are active in the Discord are they're also kind of the types that would be active on social media, which isn't necessarily people who subscribe or who listen, who are interested in listening to the things that I have to say. But it seemed to get a lot of reaction. So a few people surfaced and mentioned that they had first come across, what I was doing by way of YouTube. And so, that's probably a good thing to go back to. Certainly in this day and age where, when I'd first started the Substack, it was Twitter was or X now was awesome for reach offsite. So a couple of other people might have, tried to dilly-dally around with this a bit, but, pre the Musk, the links that you would have offsite got promoted maybe even better than original content that you would put on the site. And that was one of his major changes. So you had a lot of people start successful blogs, newsletters, what have you, off Twitter because, those links were not deprioritized. And now they are. So, the search function for people who are interested in the kind of things that, if you're listening to this, you're probably interested in these things too, is incredibly. And also the spoken medium is a good one to go after. So the purpose of the pod will be as a little bit of an accompaniment to the written work. I won't be discussing anything on the pod that I have not already disclosed on the Substack. And that's just out of respect for the people who subscribe and basically make this a possibility. I fully expect to cover things that have already been covered, perhaps in a slightly different a context than what is addressed on the Substack. This will be a little bit more free form and maybe add a little bit of color to the things that we discuss on there. And perhaps from time to time, we might have guests on, which will be cool. I'd also like to do a little bit of a reintroduction to the blog or the newsletter. This is kind of inspired by some podcasts that I've heard mostly borrowed ideas and David Kim do recently, where they were discussing their approach to the newsletter and how that might tie into the kind of content that they make and who they're writing for. So David's idea was basically that he does not come at things from the direction of a stock pitch. He comes at things basically through the lens of being curious about different kinds of businesses and not being shoehorned into a particular audience or feeling compelled to write, about a very narrow set of topics. And that was limiting to an extent, but I mean, he's also created a pretty wonderful business, him and Mostly Borrowed Ideas. And so that kind of prompted some introspection from myself and what I'm trying to do and the reason why I'm trying to do it. Initially, I, was interested in investing as a way to compound your wealth over a very long period of time. So like many of, people who are hobbyists, this is not my full-time job. So initially, you are looking for, if not shortcuts, just to shorten your search time when you're looking to, allocate your own capital. And that comes with a time restriction. Basically, if you're not doing this full time, you're not going to be able to put immense amount of time or energy into things which don't have somewhat a reasonable chance of converting into some kind of actionable insight. Your time is pretty precious. And so I always came at things from the ways of trying to get to the needle in the multiple haystacks as quickly as possible in ways that were as efficient as possible. And the unfortunate corollary of that is that if you are trying to do this kind of thing on a time budget, you can waste time, and that will be bad for your results, basically. I think it's quite a good thing to want to study business generally, and that's kind of how you get insights, the sort of random walk. But the newsletter has not been a random walk. The newsletter has been focused on either ideas that were I was really curious about for one reason or another. And most of the time I was curious about something because it had a set of economic characteristics which were fascinating. And there was something odd or strange or different. And, down that kind of rabbit hole is a much higher likelihood of finding something that's actionable rather than not. You need to fish where the fish are, if you will. And that's not everyone's approach, and I completely appreciate that. Now, there's nothing wrong with wanting to study businesses for their own sake. But my interest in many of these things was partly business analysis, but also trying to solve for limited time and trying to solve for that search function, trying to get to the bickies quickly. So, I've done a few posts which were, basically tangential to that, where I might explore or research a business that I probably know from the outset is not investable. But most of the time I'm following these extraordinary outcomes. And to the extent that I am a generalist, I don't think people should limit their opportunities. People shouldn't limit their opportunities as a general rule. So, I've found that it's always best to be curious. Especially when things sort of look like they have the inkling that they might have very interesting economic characteristics or have an interesting corporate situation around it. It's good to be curious, but it's also true that you can get way out over your skis, and you can spend waste a lot of time and energy. Now, on wasting time and energy, that's a little bit more nefarious than most people realize, because when you spend a significant amount of time on something, you fall into naturally what is called commitment and consistency bias. Now, commitment and consistency bias is a natural human misjudgment, which basically, states that the longer you put towards something and the more energy you put towards it, the more you will continue to commit to that thing. In, the context that we're talking about, that is, if you spend a lot of time on very mediocre situations, or situations that aren't going to be actionable for you ex ante, you can convince yourself that there are opportunities when there aren't, and that can lead you down some very difficult paths, which is probably why it's best that most professionals actually don't do this kind of learning in public. I get to do it because I'm not a professional. I do this mostly as a hobby and an interest, and something of a side business. So the blog has always been authoritative. I don't try and write articles in a non-persuasive way. Persuasive writing is charismatic to the mind, and it sort of feeds into constructing stories. Stories are the way that human beings have always passed along information, and it's compelling. So I've always tried to write the blog in that fashion, and I try to be as upfront as I can possibly be about the conflicts that might arise from also owning some of these securities at the same time. But that should be pretty clear. I definitely agree with many of the criticisms that most of these more established newsletter writers have about the current state of newsletters and blogs in this particular space. For the most part, these are not intellectual exercises. They are, they're kind of like a feeding off of a very large marketplace for people mostly looking for quick fixes, and that contrasts a little bit with what I have just said, but you'll find as many as you like things that will make all kinds of predictions on a vast number of different stocks, businesses, indices, macroeconomic forecasting, and the like. And, for the most part, those are just not very serious. There's no way that any individual, analyst can cover, hundreds of names properly. For the most part, you can see these just basically, they'll cover off a couple of headline ratios or valuation metrics or something like that. And then, they'll say, on our proprietary valuation model, we believe that this is worth, 400% more than, what it currently is. And then, just don't talk about your losers, talk about the winners, and, on and on it goes. There's just two, obviously I've outlined the first problem with that, which is just, any individual human being probably only going to be able to analyze or follow a relatively modest number of situations at any given point in time. And those situations are almost certainly going to fall within a couple of like domain expertise areas. Even over a long, career, the best investors out there have mostly, focused on a few important secular trends in industries. I think someone like Buffett might even be a complete outlier because, he's been pretty good across, what's been largely identified as like four disparate industries for the most part. And so, I mean, if the greatest of all time is, really out here only doing four, and, there's various financial media that's covering literally like hundreds of names. Sure how value added that is, which sort of brings me to my next point about the newsletter, which is my approach has always been to follow various economic characteristics of businesses that fall into probably a couple of different industries. Historically, this has been something like consumer internet and finance, and then a couple of interesting, anomalies around the sides of those things. And the economic characteristics that I've always been interested in are, probably things that have some kind of network effect, or they have a low cost proposition for their customers. And the reason why I've been interested in both of those is because they're probably the two most powerful quote unquote moats. Patents and government licenses and all those kinds of things, typically much weaker forms of economic protection. And networks and a low cost proposition are things that ultimately result in pricing power. If I was interested in like a second economic principle, it would be growth that does not need to be necessarily paid for, or requires very significant growth prospects with very little need for reinvestment. And so like those kinds of things fall into a very narrow set of industries, because most industries are not networked, and most businesses out there do not rely on intangibles to promote their viability. And so that's been the purpose of the newsletter. And the tertiary, more recent version of what's been going on with the newsletter has been trying to find those kind of things in extraordinary corporate situations, because as I'm sure everyone listening will know, when you find something like that, it's very unlikely that it is mispriced. And so, if it's not mispriced, the likelihood that you're going to get an extraordinary return, or even a slightly better than average return, goes down significantly. And that might be like a good introduction to the next part of the reintroduction pod a little bit later. So yeah, that's kind of what I'm doing on this podcast and what I've been doing on the newsletter. I think for both, there's certainly a larger market for this kind of commentary and analysis that I would have thought in the beginning. There's a ton of money, especially in global small, mid, and large caps, following companies that have these kinds of characteristics, but usually pretty quiet. Usually they're not doing a heap of promotion, and certainly not being promotional about some of these names that they own. And I think that's probably just as well, because there's, pretty aggressive competition to finding these things. So yeah, that's what I'm doing here. That's why I'm starting to do this again. And certainly, I think, as time goes by, it would be great to have more and more guests come on and share, some of the wider wisdom. Certainly on my travels, I've met large number of you, which has been awesome. And kind of like, that's always like it's always like a very interesting situation. Usually I am not the person asking to meet, although if I go to a particular place and I know there's likely to be a high concentration of followers or subscribers or whatever, I'll put out calls to meet up for coffee or a beverage or whatever. And I feel in most of those situations, it's kind of like the relationship before that point has been a bit one-sided. It's either me writing or talking or posting on X, and I might not have any reference point for the person that I'm meeting, even though they might be very interesting. And usually the dynamic of that of that interaction is I wouldn't say that that necessarily grilling me, but usually they have a lot more questions for me than I could possibly have for them. And so maybe we can use this as a bit of a forum to invert that unusual situation, so that more of the people listening can get some of these insights, and maybe in time we can build out like a bit of a quality purist community. We'll see. So just on that last point I was riffing on, and in the spirit of what we're going to do with this going forward would be, like I was thinking about the first topic that I could talk about, and I thought, a lot of people found me because of a post or video I made about FICO almost 3 years ago. Yeah, bit over 3 years ago. And it's obviously it reached some ludicrous valuation at the end of last year, and I've been covering the name for a very long time. And just recently, I would say start of the year, dropped coverage on it generally, even though nothing else has changed, and I certainly don't think there's anything wrong with the company. But it's like it could be like a interesting point to like readdress, just what like happened and address, like it's obviously sold off a lot. It's come down from, I think, $2,350 something a share to $1,800 a share at the start of the year. So, kicking in some pretty good year-to-date numbers so far. In between when I made that post and, at the beginning of 2022, FICO went on a multi-year tear with, almost zero drawdowns, compounded at 70 or 80% a year uninterrupted. And, that tear really did not, it's not like they were growing revenues 100% a year or something like that. Kicking in pretty much, normal, not normal, but if you take the 3 years before the end of 2021 and you look at, those years in terms of earnings per share growth and operating income growth, it's, the 3 year, from that 3 year period for the 3 year forward from the end of 2021, pretty analogous, nothing really changed. But what really did change, especially at the end of 2021 and the beginning of 2022, was expectations in the story. When I first covered this, there was a lot of overhang with the Federal Housing Finance Administration, the FHFA. There was question marks over whether or not the FICO score would be maintained in the 30-year mortgage regime. And there was significant concerns around the volumes of mortgages. So the reason why the former was important was because the necessity of the FICO score for a conforming 30-year fixed rate mortgage is that when that is mandated, that was a situation that gave the FICO score almost unlimited amount of pricing power, which was that was a serious issue at the time. And the second part there was obviously that the FICO score as a business relies on volumes. They charge a royalty per time a FICO score gets pulled. And so the score is like this ridiculous business. It has almost no operating expenses, no capex, no property, plant and equipment, no nothing, and it just produces insane amounts of cash every year with virtually zero need to reinvest. And so it's always had a quote unquote high multiple, a high valuation, irrespective of which kind of valuation you wanted to apply to it, be that free cash flow, earnings, pre-tax income, whatever. So, at that time it had, retraced from a COVID high, 50, 55 times earnings, and it got down to 25 to 20 times earnings, somewhere in that range, on these concerns. And then, its position in the mortgage regime was basically solidified by the FHFA. And then they began a series of price increases for the so-called GSE mortgages, for scores pulled for the GSE mortgages. That is like basically unprecedented in public markets as far as I know or can remember or have studied outside of biotech. So, the price of these scores was being raised hundreds of percents a year in that time period, and the difference between the expectations of what might happen to the FICO score versus the pricing actions they were able to take to overcome precipitous and catastrophic declines in mortgage, which is their most important market at the moment. Those things kind of like blew out, and they repurchased a ton of shares, and et cetera, et cetera. And so it was a multi-year trend from the end of 2021 up until probably the present day, or you can take probably the top in the share price at the beginning of December, end of November 2024. And at the end of that run, so like in 2024, shares appreciated almost 100%, I believe. And part of that was an expectation around a rebound in mortgage volumes, partially refinancing, and certainly part new mortgages. And that, at least for the time being, is very heavily tied to interest rates. So, baked into the price is basically an expectation that interest rates would come down low enough to get levels of refinancings and new GSE mortgages, at least back to a trend, pre-COVID trend level. I think it will definitely get to levels seen in 2020 and 2021 again, but those were that was a very strange and bizarre and, one-off mortgage market. So we might not see that for a while, but definitely get back to some kind of pre-COVID trend level. Certainly as the US economy has remained very robust, and there's kind of been surprises in the number of jobless claims, those expectations for interest rates have come down. You can see where the 10-year yield is at the moment. It's between, I think it's 4.4% or something like that. And the market was really pricing in maybe 3%, 2 and 3%, something like that. Almost a number, a prevailing number that would have been around in the 2010s. And I thought for a long time that seemed a little bit optimistic, thinking that emergency interest rate policy would be enacted in a very strong US economy with no real signs of slowing down. Certainly, the Trump agenda is not disinflationary or economically dour or anything like that. It's all about animal spirits. And so, the shares have been repricing that out. And, I don't necessarily disagree with a short-term, where the short-term revaluation is. I've said many times this is a very difficult company to value just because of the nature of the economic goodwill on its balance sheet. It's very, very, very hard, to normalize what the earnings number is. People certainly did not predict this with any particular accuracy in 2018. They certainly, were way off the mark in 2021 and part of 2022. And after that decision was made, and thereafter, people have been unsure about how to value, the reported earnings number, and it's been anywhere from 25 to 115 times. And I don't know. What I do know is that this is like a very unusual business, very unusual, strange. You won't find many things like it. You won't find many things like this that are run the way that they are run. And honestly, I don't care what the price is. Certainly at the plus $2,000 a share level, outrageously expensive by any conceivable metric. And if you were to try to value the business on a T+5 basis, to get kind of any reasonable above index like return, you would need to assume, an enormous refinancing boom driven by very low interest rates, and then, very significant price taking in mortgage, and probably significant price taking in auto. Probably the two most important reporting segments. So yeah, look, it's a never know with these things. I try to disconnect myself from from evaluation as much as I possibly can. I want to look at a business quality first and foremost, and then I want to look at valuation as a catalyst, usually to buy shares rather than sell them. So there's two kind of principles that I have, and these are not rock solid. They're not the right way to do things. They might even be the wrong way to do things. But Greenwald, Bruce Greenwald says that you need to have a rule around selling, and so he cites multiple different people who have a different rule, and this rule might change over time depending on interest rates and that kind of thing. But he recognizes that Buffett, kind of in the post 1970s world, has he's not a seller for the most part. He holds on to some of these long-time franchises, and that is not to say that he holds on to them forever or anything like that. His general predisposition is to hold on to businesses while they have attractive economics. So that's his approach, and cites other people, cites other investors who might come at things from they're not going to own stocks that have more than with a price earnings ratio above a certain metric or something like that. So my rule, has just been a bit of a hybrid between the two, but it's while the story is playing out and while these managers and companies are capitalizing on very unusual business opportunities, that is an association that I want to keep. And there's nothing perfect about that. People who force rank their portfolios on valuation basis, that makes a lot of sense, and it's pretty logical to want to do that. My retort to an approach like that is that on one hand, you are relying on your own projections at a point like that, and I can say with 100% certainty that almost all of my projections have been wrong in one case or another over the years. And so, my response to that is to be a lot more humble about those things. And then on the other side, you can get into a situation where you are incurring significant tax liabilities. And the costs of transacting, etc., on what might be very modest valuation discrepancies. So you might be trading out of something that is very good, but has become expensive because other people have also recognized that it's very good, and you might be trading out of that into something which might not be as good on potentially flimsy forward projections. At a price that might look more attractive, and so if I were to say, what is easier to do? Is it easier to make gradations on business quality than it is to make very accurate valuation assumptions over a very hazy forward period? My answer would be the former. I think it would be a lot easier to say that, well, this is fantastic and this is okay, and on that basis, I don't want to be trading down on quality ever, especially if that's where you see that your skill set is. I'm not sure anyone has a good skill set in predicting future earnings, and if they did, they're probably incredibly wealthy, and they won't need to be listening to this podcast. So that's Bruce Greenwald says you need to have a rule, and that makes a lot of sense. And having that rule ex ante makes a lot of sense to me. And I'm happy to make adjustments when I think the economic opportunity is not as good or not as good as I thought it would be, or there's a management change or something like that. Probably not going to aggressively force rank valuations in my portfolio, especially when I think I got a pretty good price in an entry. And then, there's Buffett doesn't like to sell, but Buffett's predisposition is to ride the entirety of a particular opportunity. Now, he's been remarkable in identifying very long-lived economic franchises. Like, it's eerie if you go back and read the 1970s Berkshire Hathaway letters, where he where they start stating the securities portfolio that Berkshire owns, run that forward to the 80s and the 90s. It's striking how many of those companies that he bought in the 70s and the 80s are still around today, and and have done well. Not they haven't just kind of died out and then just bled out on the side of the road. Many of them continue to produce profits 3, 4, 5 decades into the future. And so I kind of feel like he has, he had a similar predisposition. And so when, there are drawbacks to an approach like this, which is that, you run the risk of getting topped and tailed, especially if you're, being successful in identifying these things when they are undervalued. These things can run a lot and then become a very high percentage of your portfolio. And then, as they sell off, that can have, significant swings on the valuation of your portfolio on any given year. That's certainly a drawback. And that is, why, most professional managers along these lines, they will trim these positions above a certain weighting, in part to reduce volatility, but, also to hedge against the fact that they might be wrong. And both are perfectly reasonable as a predisposition. That is not something that I am interested in, and that's not for any arithmetic reason or anything like that. The logical reasoning is that I have just no interest in continually pruning away at my portfolio and selling things that are winning. That doesn't really philosophically make any sense to me. More than happy to get rid of something when I find something that's significantly better. That makes a lot of sense to me. And then also getting rid of things as your assumptions might be proven wrong. I think when you're off on things, the best course of action is to cut that as quickly as possible, or some version of that. That's always made a lot of sense to me. So yeah, it's FICO's sold off a lot. Nothing has really changed in my mind except those expectations around where interest rates are going. And there's quite a question mark about what the future pricing actions are going to be. There's a lot of speculation about what a steady state GSE mortgage pool will look like. I have conspiracy theories around it, which I've posted about at length. So if you want to read about that, jump onto the newsletter and you can kind of see what people are speculating that might be. But I mean, even at this point, the price of a score is incredibly modest in the closing cost of a 30-year fixed rate mortgage, and the more expensive components of it have been going up at rates on a dollar basis far outweigh it. I've been writing a little bit about Fannie and Freddie and what might happen there once they become standalone private companies again, and probably a very good chance that the cost of insuring a 30-year fixed rate mortgage goes up somewhat. The credit file, from the credit reporting bureaus, that has been going up in price in dollar weighted terms far more. Title insurance, et cetera, all these things have been going up. So I'm optimistic from the perspective of the price of the score in that particular use case, having quite a ways to go. And I think it's been quite, interesting that the price of the score otherwise, so let's say auto, credit card, personal, hasn't really gone anywhere in a number of years. And so, I want to see how that story plays out as well. So yeah, look, that pretty much wraps up everything that I wanted to talk about for this week. And going forward, hopefully I can drop one of these kind of every weekend or so. It's the Australia Day public holiday here today, so got a little bit more extra time as usual. And yeah, we'll keep going along.